Hello everyone. France's debt crisis is sending ripple across the global markets, highlighting how rising bond yields and widening spreads are reshaping the investor sentiment and the fiscal dynamics. With government borrowing costs reaching multi-year highs, heavily indebted economies like France are facing heightened vulnerability amid structural liabilities and tighter monetary conditions. France's public debt now exceeds 114% of the GDP, while the unfunded pension obligations are nearly 400% of the GDP. The 2025 fiscal deficit stood at 5.4%, but markets expect that it could rise to 5.8%. This has pushed the French bond yields higher, with the 10-year bond yield currently trading at 3.52%, about 79 to 80 basis points above the Germany's 10-year bond yield, reflecting the growing risk premiums and the rising refinancing costs in France. This is not just a French problem. Globally, investors are demanding higher term premia on long-dated US treasuries, signaling concern about the structural fiscal sustainability. Within Europe, the ECB's policies like negative rates, PEPP, OMT programs, and the anti-fragmentation tool have calmed the market short term but may have reduced the fiscal accountability, fostering reliance on central bank support rather than meaningful reforms. Markets should brace for heightened volatility in the sovereign debt. Policymakers must prioritize fiscal consolidation, pension reforms, and credible debt management. In the short term, the euro is likely stable as markets have already priced in the potential political changes in France. However, without the structural reforms, prolonged fiscal deterioration could eventually pressure the euro and broader European stability. Thank you and stay tuned for more updates.